Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another edition of the weekly economic review, this time for the week ending September 3rd, 2021. Maybe before I start, it was brought to my attention that over the last 2 weeks I was using the laser pointer here, and it did show on my screen, but it didn't show in the recording. So, no need to question my mental health here. It was only a bug, and I will be refraining from using that from now on, or at least until Microsoft offers an option to record the use of the laser pointer. So sorry about the confusion if it confused anyone out there. So look at this week's markets at the close on a Thursday. So positive pretty much everywhere on the week. As I'm recording, this markets just opened on Friday morning. We did get the non-farm report, so the jobs report in the US at 8:30. It was a bit of a negative surprise, but bad news seems to be good news for some sectors right now. I'll explain the rationale for that. We're seeing some volatility this morning, so maybe when you look at the picture at the end of the week, maybe it'll change a little bit, especially in interest rates. This morning, we're seeing a hike in interest rates, a rise in interest rates rather, coming from in reaction to the jobs report. Accelerating wages might be causing a bit of that, but still, after 4 days, we did have a pullback in interest rates. The long index in Canada was up 0.8%, so we'll see if we change the color here of this move today. Equities were actually pretty positive, led by emerging markets. Remember that emerging markets, if you look on the right side, the year to date, we're seeing a 20% plus returns in North America, 17% in Europe and Asia, and a very lowly 3.9% for emerging markets. So we're starting to see some catching up from emerging markets. Is it the time to buy? Still or too early to tell, but there is a big gap between the performance of emerging market and most specifically China. The China index is down over 30%, and it represents a third of this index, so weighed immensely on the index. But on the week, emerging markets, EFI, S&P TSX, and Nasdaq were leading the way. So good returns for equities this week. Price of oil also touching $70 on the close on a Thursday. Canadian dollar up, euro up, and the price of gold down. So if we look at the COVID situation, this is very an interesting development. It's a sad but interesting development. On the left, you see Israel. The data is showing that this wave is the worst wave ever, and many articles in the media. If you just Google Israel and COVID, you'll find some very interesting material about the how the risks are still very well and alive. So I'm not a doctor, and I'm not here to take a position on any of these issues. I'm just here to look at the data and tell you what the data are saying. But the Israel situation this summer, the Israel moved towards complete reopening, so back to the previous life. So there was they removed the mandatory mask mandate for indoors, so they removed that during the summer. Social distancing was not the norm. They reopened the schools just like before, and the cases spiked. And now you have the Israeli government just sending a message to the other countries to maybe we were too early. Don't make the same mistakes as we did. So the risk is alive and well with COVID. So it's not because we are. I'm personally vaccinated. If you are vaccinated out there, and you see my friends are vaccinated too, why are we still in there? Well, Israel is a good eye opener here. So Canada, on the chart on the left, you see that we are also in the fourth wave. We're still doing relatively good compared to other countries, but still it's not one. And on the right, so hospitalization. So again, I'm an economist talking to you. So the COVID cases become COVID hospitalizations, and when the hospitals are overwhelmed by cases, that's where governments close the economy down, and the markets don't like that. So this is the link between me talking about COVID and and the markets and the economy. So we need to look at hospitalizations. So on the right, you see that the Canadian situation is still favorable compared to the past. So if you look at the bright red line on the right, you see Canada, we're in an uptrend, but we're still doing fine. Alberta's in more of a sticky situation, so more focus there. Other provinces are doing not too bad, but still so far so good, but it's still a risk. And when you look at the economic data in the US, because the US is the largest economy in the world, so what happens there matters more for markets. So we need to look at that. So we're starting to feel the first economic impacts from the fourth wave. It seems to be the case. If you look at the major macro variables, they're always published with such a lag that we can count on them. So we need to rely on high frequency data. High frequency data are telling us right now, this is the open table, US seated diners, so people making restaurant reservations, starting to see a downtrend here. So people are going less and less restaurants compared to the same period in 2019. So this is a very early sign. It's not a red flag. Let's call that a very light shade of yellow flag, but still we are starting to see these impacts. So the moral of the story here is that for the rest of the year, COVID seems to be back into the column of the main risk factors. It was always a risk factor, but these risks are starting to materialize. So very important to keep our eye on the ball here. Before going back to the US, China stays slowing down. China is one of the most important economies in the world. We do see the Chinese economy being caught in a bit of a rut here. But the good news is that the Chinese administration is actually very proactive in how they address the economy. So we're already seeing the credit impulse starting to rebound. We're hearing things from the government that they want to stimulate their economy. So probably by the end of the year, we'll see a turnaround. But no one is shielded from the slowdown that we're seeing here from the cases of COVID. On the right, you see the services sector expected for the PMI was expected at 52. So anything above 50 means an acceleration month over month, and anything below means a contraction. And we fell to 47.5. So a small hiccup here. So that explains a bit why emerging markets have underperformed recently, but we are hopeful that China will do the right thing again and stimulate its economy towards the end of the year. So back to the US, the jobs creation, it slowed very abruptly in August. We had 235,000. That was the second worst since the beginning of the year. So you have all of the months for the year here. January was 233. That was the lowest one. As you can see, you can see like the pattern of wave of COVID. So distancing after that, reopening, and another wave of COVID. So you can see that in there. So it's normal that we have some stop and go in this. But what's very interesting from this report is that the answer is definitely yes, that COVID is starting to have an impact on the labor market again. Maybe I'll go back to a few charts to explain that. So consumer confidence is in focus. Mentioned over the last few weeks that the University of Michigan Confidence Index, the orange line here, crashed down to a 10-year low. So you need to pay attention when something like that happens. But I did mention that the broadest survey, the most widely followed surveys, the Conference Board Confidence Index, well, it's the gray line here. So same direction down, but not as much. So it's kind of, again, a very light shade of yellow flag that we're seeing here. So consumer confidence is lower. People are saying that they're less confident about the current situation and their expectations. And the reaction to that is that we're already starting to see the savings rate contract quite a bit. So people are using their savings that they accumulated over the last year or so. So to stay at home instead of going back to work. This is exactly what we're starting to see. Remember, the U.S. strategy was to send checks to everyone, so everyone got some money. Those that kept their jobs, well, they couldn't spend as before, and they got the government check, so the savings rate was up. It went all the way 35% at some point, and then it came down very quickly because of this here. So there was this survey, and we always get the best stories when we look at the surveys. The survey was, why are you not urgently searching for work if you are unemployed? And the principal reason, the main reason, is the one in the middle, the financial cushion. So I have a lot of savings. I'm not going back to work because I've got money to survive for a while before I'm forced to go. As you can see on the bottom, you also have COVID fears. You have the unemployment insurance payments. That's still true in some states. Others, it's completely removed by now. Care responsibilities. The spouse is employed. So all of these reasons are making so that people are rather staying at home than going back to work. And this is what's going on. So it's not like the economy now. No one's hiring because everyone wants to hire right now. We'll have next week the JOLT survey for the US. The expectations are that it will show that there's more than 10 million open but unfilled positions in the US. So when you see help wanted in a window in front of a store, well, they count all of that, and there's 10 million jobs available if you want to work. But most of these jobs that are available now are in the leisure and hospitality sectors. So everything that leads to that linked to services, and everything that was drastically impacted by COVID. And in these sectors, we are not seeing people wanting to return yet. They want to, this is kind of a last resort thing to go back to work. So this is holding the economy back. And it was confirmed by the labor market report this morning, the non-farm report. It used to be, over the last many months, it was the leisure and hospitality line that was explaining a large part of the job gains. So people were going back to work in services in large numbers. And this month in August, the number was zero. So a big fat zero. So no one wanted to go back, or net it was zero. So that tells you a lot. So COVID is still a risk. It's impacting economic prospects, and we still need to factor that into our analysis. So this is the US story. Back to Canada, surprise GDP contraction in Q2. So the expectations were for 2.5% quarter over quarter. In the US, it was 6.5%. So the Q2 was very strong in the US. Canada, we expected something weaker, but still good. But we got minus 1.1%. And we say surprise because StatsCan came out with some revisions to the months of April and May. Instead of gains, we had contractions. So they were revised lower. So that means that we had a surprise contraction. So now Q2 was negative. StatsCans, they always come with a forecast for the next month, and their forecast seems to be pretty precise. They're expecting minus 0.4% month over month for July, so July being the first month of Q3. August, we're battling this COVID wave. September, we should be battling this COVID wave too. So there is a real risk here of having 2 consecutive negative quarters in Canada. So that means a technical recession. So there are some risks. It's too early to say that, but there are some risks that we could have a technical recession. Of course, in Canada, you can dissociate the economy and the markets. So you can have a recession, technical recession in a year, and have a stellar year for the TSX and vice versa. So it's not like in the US where the economy and the S&P 500 are more closely linked, but there's a real risk of very soft patch here in the middle of the year for the Canadian economy. So the challenges are real. And talking about the challenges, maybe just an update on the election campaign, not doing any politics here, what the polls are saying. So this is a poll aggregator. So here some French remain, but this is as of September 1st, 2021. This is an aggregator from CBC. So they look at all of the polls, put them together. So now you need 170 seats for a majority. Right now, if the elections were held on September 1st, 138 seats would have gone to the Liberals, 132 for the Conservatives, and after that, you have the other parties. But on the right, this is very interesting work that they're putting together. The probabilities, the chances based on the surveys. So only 8% chance that we have a majority Liberals government, only 4% a majority Conservatives, but very, very likely and close to a coin toss that will have a minority government, either liberal 45% or conservative 42%. So it's still very much a neck-to-neck race. The big challenges remain managing the deficit, the health situation, so vaccination, making sure hospitals have the money, and environment is also on top of the list. So we are headed towards the election with some real challenges. The economy is still needing some support, so we'll see where we end up. But the campaign is getting closer and closer here. So financial markets now, the Fed last week, if you remember, I said that I record these things usually before market open, and we were expecting a speech from Mr. Powell at 10 a.m. So it was when you listen to the review, the speech was out, but when I recorded it, it wasn't. And finally, the message was pretty dovish. Mr. Powell was very good in dissociating the taper, so the end of quantitative easing. And just a reminder, quantitative easing is the Federal Reserve, so the US central bank, printing $120 billion a month to buy bonds to push interest rates lower, because when you buy bonds, you push interest rates lower. And if interest rates are lower, that means that when you go to the bank for a mortgage, to buy a car, to buy anything, well, the preferred rate will be lower, so that means it's easier to have access to credit, and it costs less to finance your buying. So this is the strategy. So they say, well, probably with the inflation levels that we have here, it's time to start tapering or putting an end to that. So they should announce something by the end of the year, probably November, and by the end of the summer 2022, probably they won't be doing any quantitative easing anymore. That's kind of the message that he's sending. We'll see what happens, but that's the message. It was very good though at separating this, and so decoupling this from the first hike in interest rates. And looking at things, they said that they think inflation is transitory. Rate hikes are not needed right now. Still a lot of progress to go, and they did point towards somewhere early 2024. At least that the consensus amongst all of the very credible Fed observers that I tend to read on a daily basis. So what that means is this speech here supports the markets, because the consensus now, at least what's implied from the current levels of rates. So if you do the math and you look at the interest rates, you can imply what the views of the investors. And now the investors are thinking that, well, what's priced in rather is that the first rate hike would be likely in February 2023. So that's early 2023, and a second one in September 2023, while Mr. Powell is talking like a man who aims at somewhere early 2024. So that means that interest rates will remain low for lower than we think. If we listen to this message, interest rates could go a bit lower. So that's why we had gains in bonds this week, interest rates lower, and stocks tend to like these kind of environments. Bad news can become good news, well, bad news, that means the Fed will have to stay around. Liquidity won't be going away. So buy stocks, buy bonds, buy a bit of everything. So it's this kind of market that we're starting to see. We'll see how it unfolds over the next few months. But this week, we did in our portfolios add more exposure to the US stock market. I always say that our strategy for a good few months was to be underweight the U.S. stock market, overweight Canada, overweight EFI, so or Europe and Asia. We shifted that. Now it's neutral in the U.S. We let go some of our Canadian stocks to be slightly overweight equities, but neutral in the U.S., slightly overweight Canada, and we like our positioning like this. So we'll see what happens, and if we make any further changes, you'll be the first to be informed here. Wall Street, again, we're making a new highs again. So the number of new closing highs, so the days where you've seen the news that, well, we closed at the all-time high, well, that's 53 now in 2021. The record is 77, so I don't know if we'll be reaching that, but we're starting to be in the top levels of the all-time. Of course, when you look at the company that's here, you see 1987, you see 1928, 1929, but you also see 1998. So it's a mix of many things. So that doesn't mean that we're gonna necessarily end the year higher or lower, but there is a lot of appetite right now for equities, and with the speech of Mr. Powell, that could continue, even though volatility can never be excluded. appetite for stocks will remain. And since I get the question, I got the question quite often recently. I thought I'd address that. Should we fear the September effect? And for those that are not familiar, September typically has been negative for equities. It's always the very neutral to negative month. We don't base our strategies on seasonality ideas like that, although we need to pay attention. In the last 4 years, 3 times out of 4, September was a positive month, so it hasn't been true recently. But a few analyses that we ran showed that if you come into September with some momentum, so if the market is in an upswing, then it's about 50-50 the odds that you have historically, 50-50 the odds that you have positive month versus negative month. And if you come in September on a downtrend, then it's about 30% positive and 70% negative. So we're entering with strength. So it's kind of a coin toss. So we'll see what happens. But we don't tend to base our strategy on things like that. But I can tell you that we remain close to neutral, and we've remained close to neutral for a long while because we have seen volatility being very elusive since October of last year. And in this kind of environment, we do like to wait for a strong opportunity to add risks to the portfolio. So we've had a very good streak. We think neutral is the place to be right now. Slightly neutral, a bit overweight, but still very much neutral. And we will use volatility opportunistically if it comes, but we never know when it can happen. September effect, something, but we don't really base our strategy like that. So finally, what to watch next week? Bank of Canada rate decision. No change expected. We'll have our labor market report. Last month it was 94,000. Let's see what we get now. Unemployment rate was at 7.5%. In the US, we'll have the JOLTS job opening report. As I mentioned earlier, 10 million jobs are open. So US is open for business. It's people that are still reluctant to go back to work. And the producer price index showing some inflationary pressure, 8.3% year over year. It tends to be volatile. Correlation with CPI is not that clear, but still need to pay attention when you see these kind of figures. So that wraps it up for the week. ia.ca/economy, our webpage. You can always subscribe to the newsletter if it's not done. Last week, we had I think a few technical issues with the typical email for those that want to have access to the PDF. So we'll send both PDFs early next week. But if you want a copy of this presentation, or just write economics@ia.ca, we'll add you to the list and we'll send you the PDF version of the presentation. So thank you for your trust. Thank you for following us every single week. And I'll be back again next Friday with another edition of the Weekly Economic Review.